Howdy, y'all. Welcome back. It's the weekly economic update for July 26, 2021. I am Raymond Dahlman, your humble host here at DSA Financial Group. And hope everyone had a fantastic weekend. Sorry I did not get a video out last Friday. I was unfortunately very busy at the conference I was at, Freedom Fest. It was a lot of fun. My wife and I went up there to Rapid City, South Dakota, and got to see and meet a lot of folks and attend some interesting classes. And so that was my week. And unfortunately, Monday got started off to a shitty week. Trying to back my fifth wheel back into the driveway, I backed over the gas meter, and I also turned too sharp and broke my part of my back glass in my truck. So it's been an expensive morning. But the gas guy just got the gas meter put back on and fixed, and I have an appointment for Wednesday to get my back glass replaced. So hope everyone else has had a much better Monday than me, but stayed calm when the gas was spewing out of the pipe. I stayed calm, remembered my training from the Navy, ran and grabbed a wrench, ran back out to the street and turned the valve off. So, and there was no fire, which was that even better. So alrighty, well, let's go ahead and jump into the weekly economic update for this week. Starting out, the week on Wall Street, overcoming a COVID-related economic growth scare. Stocks moved higher amid a week of strong corporate earnings. The Dow Jones Industrial Average was up 1.08, while the S&P 500 gained 1.96. NASDAQ was up 2.84 and international dipped 0.2. So here in America, domestically, it looks like stocks were doing very well based on earnings. Not so good or flat, I guess I would call it, for overseas. See, Delta variant head fake. Stocks staged a broad retreat on Monday as traders worried about the adverse economic implications of growing Delta variant infections. Okay. Especially sensitive sectors such as energy, financials, industrials, materials absorbed the brunt of Monday's sell-off. But the markets did a quick about face, posting 4 consecutive days of gains, leaving 3 major averages with fresh record highs. The sharp reversal may be attributed to a buy on the dip investor mentality, the absence of investment alternatives to stocks in this low interest rate environment. That is a problem. It is normally when stocks, you think they've run their course, or you expect some sort of a downturn, you'd go to bonds. Well, bonds don't really pay a yield that's worth a damn anymore. And if you're buying treasuries or treasury bonds, they're valued in the U.S. dollar, which, there's a lot of folks who have a little indigestion about, where the dollar is going and how the Federal Reserve is handling that situation. So we'll see. And a massive financial liquidity. Stocks were also lifted by a healthy kickoff to the second quarter earnings season. Strong start. The earnings season moved into full swing last week, and the result exceeded the market's high expectations. Of the 120 companies in the S&P 500 that have reported as of last Friday, July 23rd, 89% of them beat the street's earnings per share estimates by, on average, 20.6%. Financials and consumer discretionary sectors provided the biggest surprises, plus 28.9 and plus 24.5 respectively, while materials and utilities delivered the smallest positive surpluses, plus 5.3 and 0.25%. These earnings beat the leading Wall Street analysts to raise earnings estimates for 3Q 2021 through 1Q 2022. Final thought, the National Bureau of Economic Research said that last week the pandemic-induced recession ended in April 2020, officially lasting 2 months and making it the shortest recession in history. Well, that might be true. But, like I've said in most of the meetings I've had throughout the, definitely recently and most of the last year, is that, yes, technically, it meant the criteria for recession, But typically when you go through a recession, you wash out a lot of the malinvestment out of the market. The companies that are failing are either closed or bought up and absorbed by more efficient companies. But that's not what happened last year. Last year the federal government, went to the Federal Reserve and they just started printing and printing and printing. And a lot of those, yes, a lot of companies have gone out of business over the last year, mostly your mom and pops. But I imagine there's a lot of those mid-sized companies and maybe even some larger companies that are hanging on just simply because of the stimulus that they've been getting. So I wouldn't be shocked to see another downturn here in the upcoming future. So that's my personal opinion. You do what you want to do. If you're not a client of mine, that's your business. But I'm advising the folks I work with to be careful right now because we are certainly in some weird times right now. All right. So the week ahead, as far as economic data, today new home sales. Tuesday, consumer confidence and durable goods. Wednesday, the FOMC announcement, and Thursday, GDP and jobless claims. We got a bunch of companies that have earnings this week. Tesla and Lockheed Martin today. Tomorrow is Apple, Microsoft, GE, Advanced or AMD, Visa, Alphabet, which is Google, Starbucks, 3M, UPS, and Mondelez International. I'm not familiar with them. Wednesday, we got Facebook, Boeing, Qualcomm, Bristol Myers Squibb, PayPal, Pfizer. I bet they're going to have a good quarter. McDonald's, Shopify, ServiceNow, and Thermo Fisher Scientific. Thursday, Amazon, Ford, MasterCard, Twilio, Merck, the Southern Company, Northrop Grumman, Comcast, Anheuser-Busch, and AbbVie. And then on Friday, we got Exxon, Caterpillar, Chevron, Procter & Gamble, and Charter Communications. All right. So I have one white paper going out this week. My ghostwriter, I guess, is taking some time off. Basically just recapping a roaring start to the earnings season. It starts out corporate earnings season has begun, and the results were turning heads on Wall Street of the 120 companies. Yeah, we just covered that. The robust results are leading Wall Street analysts to raise estimates for third and fourth quarters, as well as the first quarter of 2022. Earnings season occurs 4 times a year. Yeah, we know. It's usually when the quarter ends. So, I swear. Okay. All right. So I had 2 articles I did want to just touch on briefly before wrapping up for today. I'm still catching up from last week. So this first one is from First Trust and comes from Brian Westbury, their chief economist. It's titled Inflation, Shutdowns, and Spending. Let me just start out here. Someone once said, technology has never moved this fast and at the same time will never move this slow again. So true. A partial list of recent technological advances includes messenger RNA, gene therapies, 5G wireless blockchain, the cloud, low orbit communication satellites, which is Starlink, and vertical indoor farming, and much more. At the same time, the government in the United States has never been larger and more intrusive. Yeah, that's my big problem. This makes economic forecasting, investing, and a balancing act between the supply side of new technology and the demand side of government intervention. We know that government intervention usually leads to bad things. In the case of the Federal Reserve, which meets this week, the Fed is far less concerned than it should be about the falling behind the curve on inflation. As a result, we don't expect any significant changes to monetary policy. Obviously, the Fed is still a long way off from raising short-term interest rates, but as we explained as far back as mid-June, when the 10-year Treasury note yielded roughly 1.5%, financial markets were much better prepared for an announcement about tapering and an eventual end of quantitative easing than they were back in 2013 under Fed Chair Ben Bernanke, when we witnessed the taper tantrum. In other words, we think the Fed will continue to kick the can down the road, though it shouldn't. So we've already touched on the next paragraph talks about the consumer prices that are up 5.4%. and they're at an annualized rate at 3.5% since February of 2020. So ignoring this problem, it's kind of like if you have like a lump growing on you, or you have you're constantly coughing and hacking up blood. You probably want to go get it checked out and try to fix it, or at least try to treat it. The Federal Reserve and our government just would rather put their blinders on and their rose-colored glasses and assume that everything's going to be fine. I worry that we're going to have more inflation, which is really going to hurt seniors who are on fixed incomes, because I certainly don't believe that Social Security is going to match the inflation, and I don't think our government could afford to pay the inflation rate to feed everybody. So I just see that this is going to cause some real tough problems for those at the lower income levels of the spectrum. So we'll see. I mean, I could be completely wrong. I mean, inflation could be it could disappear tomorrow. But, while we still have, the Federal Reserve increasing the dollar supply, buying up toxic assets, there's just too much money that's being created. And, if they were to stop that today and just say, hey, we're tightening our belts, we're not going to do this anymore, I'd feel a lot better. But, we'll see. And then the other article I wanted to go through real quick is it says June new home sales, new single family home sales fell 6.6% in June to a 0.676 million annual rate, well below consensus expected of 7.96 million. Sales are down 19.4% from a year ago. I don't know if that's a fair comparison. A year ago, people were starting to, they had been working from home for a couple of months, and there was a glut of people who were realizing, hey, I don't have to live in Houston anymore and sweat my ass off every day. I can move to where I live in Colorado and live in the mountains where it's nice and cool, and I don't have to deal with crime and idiots and traffic and all the problems that you have to deal with in the city. So, I would say that's a little skewed. In my opinion, just looking at the data, I would say that the reason sales are down primarily is just the lack of inventory. Most of the homes that, most of the inventory that was available has been gobbled up. Secondly, people who have moved have done it. And, I know that, the homes here around where I live, they usually go on the market and they're sold within 2 or 3 days. So granted, I live out in the middle of nowhere in a community where people who don't want to live in the city typically move out to. So moving down to the next bullet point, sales in June fell in the Northeast, South, and West, but rose in the Midwest. The month's supply of new homes, how long it would take to sell all the homes in the inventory, rose to 6.3 in June from 5.5 in May. The gain was due to a slower pace of sales and 23,000 unit increase in inventories. Last bullet point, the median price of new homes sold was $361,800 in June, up 6.1% from a year ago. The average price of new homes sold was $428,700, up 12.2% versus last year. All right, so what are the implications? New home sales continued to disappoint in June, posting a third consecutive monthly decline to come in below the most pessimistic forecast by any economics group. New homes were sold at a torrid pace in the second half of 2020 into very early this year, but have since declined substantially. Why the sales drop? We think for two main intertwined reasons. Lack of supply. I just said that. Plus rapid price appreciation versus pre-COVID levels. So lack of supply, and homes have gone up like crazy. I mean, like my house was built in like 1976, I think. Just kind of your typical house you'd find out, in the mountains. A little over 3,000 square feet. I bought it, or my wife and I, we bought it, for under 500,000, and today it's pushing between 700,000 and 800,000. And we've only been here 4 years, so 4 years and a month to the day. We moved in June 26th of 2017. So So let's see, pre-COVID levels. Look for builders to ramp up construction in the year ahead, particularly once excess job benefits are finished, and for added supply to facilitate more sales while slowing the pace of new home price appreciation. That said, buyers are still stuck dealing with very few options when it comes to completed houses. It is true that the overall inventories have been rising recently and now sit at the highest level since 2008. This has pushed up the month's supply. We just talked about that. However, almost all of these inventory gains continue to come from homes where construction has either not yet started or is still underway. Doing a similar calculation with just completed homes on the market shows a month supply of only 0.6, near record lows that go back to 1999. The good news is that inventory of completed homes rose in June for the second month in a row, and after nearly a year of straight declines. And while it's too early to say if this represents a new trend, there are reasons to be optimistic. So all this is going to level out. I have expectations that if we have a market collapse, a stock market collapse, or a dollar collapse, that it's going to just reshuffle and calibrate all the homes in the United States. So, I could move, but where would I go? If I was going to leave my little acre here in where I live now, and I would certainly go further west and want to be as far away from, I'd want to live near a city or a town like Leadville, or somewhere that's hours away from the larger metropolises. So anyways, all right. Well, that's everything I had for today. Short, I still rambled on for 16 minutes, but so a little light on material. Definitely have more on Friday, and hopefully we have a good week. Earnings, like I said, the earnings are looking good. Now if we could just get the government to turn off the welfare for the lazy people so they get their butts back to work. And you know what? You're not going to get $15 an hour to flip burgers. Hate to break that to you. So anyways, all right. Well, everyone have a great week. And like I said, I'll be back on Friday with the weekly wrap up. And if anyone needs anything from me, give me a call, shoot me an email. I'd probably be a little bit of stuff, some more meetings this week that I have. Plus I got some catch up I got to do. So everyone take care, and I'll talk to you on Friday. Bye-bye.